Welcome to Module 4 of our complete English masterclass on capital markets and securities. In Modules 1 through 3 we built the foundation of conventional bonds. Today we open the door to a different and more interesting world, inflation-linked bonds, also called CPI-linked bonds, or linkers. Before we get to the linkers themselves, we have to confront a fundamental concept that has been hovering in the background of every episode so far. The distinction between nominal returns and real returns. Inflation eats into nominal returns silently and continuously. Real returns are what is actually left after inflation. Understanding this distinction is not optional in fixed income. It is the foundation on which inflation-linked bonds make sense. By the end of this episode you will know precisely what nominal and real mean, you will master the Fisher equation that links them, and you will see why inflation matters for every investor over every horizon. This is foundational economic mathematics. Section 1. The basic difference between nominal and real. A nominal return is the return you see in your account statement. The dollar amount, the percentage growth, the number you compare to a benchmark, all of these are nominal numbers. A real return is the increase in your actual purchasing power. The amount of additional goods and services you can buy with your wealth. The two are not the same. If your investment earns 5% nominal in a year when prices rise by 3%, your real return is approximately 2%. Your account grew by 5% in dollar terms, but the dollar bought less, so the true increase in your standard of living is only 2%. For a single year the difference is small. Compounded over decades, the gap between nominal and real returns determines whether your wealth actually grew or merely treaded water against inflation. Section 2. Why inflation exists and why it persists. Modern fiat currencies typically experience persistent low inflation by design. Central banks target 2 to 3% annual inflation as a policy goal. Why? Several reasons. First, a positive inflation target gives the central bank monetary policy room to cut nominal rates without hitting the zero bound. Second, mild inflation lubricates labor markets by allowing real wage adjustments through nominal stickiness. Third, deflation, falling prices, creates dangerous incentives to delay spending and investment, which can spiral into recession. So central banks deliberately design monetary systems with persistent mild inflation. The result is that money loses purchasing power continuously, even in the best-managed economies. Investors who ignore this lose ground continuously, even if their nominal returns look fine. Section 3. The Fisher equation in its simplest form. The relationship between nominal and real returns is captured by the Fisher equation, named after the American economist Irving Fisher. In its simplest form, the Fisher equation says that 1 plus the nominal rate equals 1 plus the real rate times 1 plus the inflation rate. Mathematically, if you earn a nominal return R nominal, and inflation is pi, then the real return R real satisfies the equation 1 plus R nominal equals 1 plus R real times 1 plus pi. For small values of R and pi, this simplifies to the rule of thumb, real return approximately equals nominal return minus inflation. So if you earn 5% nominal and inflation is 3%, your real return is approximately 2%. This approximation is good enough for almost all everyday calculations. The exact formula matters when inflation or nominal rates are high. Section 4. The exact Fisher equation versus the approximation. Let us see when the approximation breaks down. Take a year of high inflation. Nominal rate 10%, inflation 8%. The approximation says real return equals 10 minus 8 equals 2%. The exact formula gives 1 plus 0.10 divided by 1 plus 0.08 minus 1 equals 0.10 minus 0.08 over 1.08 equals about 1.85%. The approximation overstates the real return by about 15 basis points in this case. For most everyday situations, 15 basis points is acceptable. But for serious quantitative work, pricing inflation-linked bonds, computing real yields in high inflation environments, comparing investments across countries with different inflation rates, you should use the exact formula. The approximation is a teaching device, not a working tool for professionals. Section 5. The ex-ante Fisher equation, expected inflation. There is an important refinement. The Fisher equation as typically stated relates realized nominal returns, realized real returns, and realized inflation. But when an investor makes a decision today about whether to lend or borrow, they cannot know realized inflation. They only have expectations about future inflation. The ex-ante Fisher equation therefore says that the required nominal rate today equals the required real rate plus expected inflation. Lenders demand compensation not for actual inflation, which they cannot know, but for expected inflation, which they can estimate. If expected inflation is 2%, a lender requiring a real return of 2% will charge a nominal rate of about 4%. This ex-ante version is what actually determines market interest rates. The bond market sets nominal yields by adding expected inflation to required real yields. When expectations change, yields change. Section 6. The inflation risk in nominal bonds. Now we can see why conventional fixed coupon nominal bonds are risky for long-term investors. The coupon and face value are fixed in nominal dollars. If inflation turns out to be higher than expected when the bond was issued, the real value of the coupons and the principal repayment shrinks. The bondholder receives the promised nominal cash flow, but it buys less than they thought it would. The borrower wins, because they repay a debt that has been devalued in real terms. The lender loses, by the symmetric amount. This is called inflation risk, and it is the single largest risk facing long-term holders of conventional nominal bonds. A pensioner who holds 30-year nominal bonds is making a massive bet on inflation expectations being correct. If inflation surprises to the upside, the pensioner's living standard erodes over the decades of retirement. Section 7. Historical episodes of inflation risk. History gives us several dramatic examples of inflation risk hitting nominal bondholders. The German hyperinflation of 1923 destroyed essentially the entire German government bond market in real terms within months. The Israeli inflation of the 1970s and early 80s peaked above 400% annually, wiping out the real value of fixed coupon shekel bonds. The American great inflation of the late 1970s pushed nominal treasury yields to 15% and inflicted enormous real losses on long-term bondholders. The Argentinian inflation episodes of the 1980s through the present have repeatedly destroyed the real value of peso bonds. These episodes are not historical curiosities. They are reminders that inflation risk is real and consequential, and that nominal bonds offer no protection against it. Section 8. The case for inflation-linked bonds. This is where inflation-linked bonds enter the picture. A linker is a bond whose principal and coupon are tied to a published inflation index. If inflation runs higher than expected, the linker's payments rise to compensate. If inflation runs lower than expected, the payments are smaller, but the investor's real return is preserved. Linkers do exactly what nominal bonds cannot do, they protect the real value of the bondholder's wealth against unexpected inflation. For pension funds with real liabilities, for individuals saving for a real retirement standard of living, for endowments with real spending obligations, linkers are the natural fit. The case for linkers is not that they always outperform. The case is that they hedge a specific risk that conventional bonds cannot hedge. In the next episode we look at exactly how the mechanics work. Conclusion. We have set up the foundation for inflation-linked bonds. Nominal returns are what you see. Real returns are what you can buy. The Fisher equation links them precisely. Central banks deliberately design monetary systems with persistent mild inflation. Conventional nominal bonds bear inflation risk that can be enormous over long horizons. Historical episodes from Germany to Israel to the United States to Argentina remind us that inflation risk is real. And inflation-linked bonds offer a structural hedge against this risk by tying their payments to an inflation index. In Episode 2 of Module 4 we get into the precise mechanics of how a CPI-linked bond actually works, how the principal accrues, how the coupon is computed, what the index lag means, and how the bond's cash flows actually arrive in practice. If you found this episode useful, please share it and subscribe to Capital Markets and Securities with Michael for the full 48-episode course. Module 4 has begun.